Well, Steve Keen is a professor of economics at the University of Western Sydney and joins me now live from Sydney. Good to have you with us. So how much of a big deal is it that the US has been put on a credit watch?
Well, it's not as bad for the US as most other nations because, of course, the US can borrow in its own currency, and there's fundamentally no problem for the US in repaying its debt in its own currency. That's quite a different situation to the European countries, which really don't own the euro, and therefore if they get a large debt which is not covered by the European Central Bank, then they potentially can't cover their deficits. And of course, if a country like Brazil wanted to do that, they'd need to borrow in American dollars, and to get those, they've got to trade and build up a trade export surplus. So America doesn't have those problems. It's not as big a deal for them as any other country.
But if America's credit rating is downgraded, I mean, what does that mean for its biggest creditors, China, for example, who are pushing really hard for a debt agreement?
Well, that's where you get trouble, because many countries around the world and many corporations have large parts of their asset base in US treasuries. And if those treasuries are downgraded, then it means that when they be sold to another speculator, which is what all those buyers really are, then they'll get a lower price for them, and therefore the asset backing of those corporations and countries falls, and some corporations in particular might be forced to sell assets to rebalance themselves, so you get a contagion effect coming out of that. And this is really the big problem with the ratings agencies. They make systemic problems worse. And in fact, they actually created the systemic crisis in the first place. So there is a need for a fundamental shift away from what I prefer to call the discredit rating agencies.
Yeah, why are they so influential? I mean, who are these companies? Who runs them?
Well, this is the thing. As was mentioned in the previous calling, there are private organisations which make money by selling ratings to other organisations. Now, in one sense, this could be a bit like a consumer group, which consumers use to say, is this a good computer or a bad computer? Only the trouble is the people who pay for the ratings are the companies themselves that are selling the computers. So what do? They say every dodgy, badly made computer is top-notch. You buy it and it crashes on you. It's not the right way to organise it. It should be the buyers who pay for the ratings. That's the fundamental problem to begin with, and it could be addressed by going over to a not-for-profit approach for these rather than the for-profit institutions which S&P and Moody's and Co are. But at the same time, this only works when you have what you can call episodic crises, where one particular organisation is bad and others therefore look better when one goes down. We're in a systemic crisis, and if you have organisations like Moody's and S&P coming out and giving somebody a decline in their ratings during a systemic crisis, it makes the systemic crisis worse. And really, they fundamentally are making this, they created the problem in the first place by rating junk bonds as AAA, and now they're turning a systemic downturn into a worse one, and they frankly don't have the brain power necessary to give us an alternative.
Well, wasn't there a plan by federal regulators to limit their role last year, because their reputation had taken such a bashing after they'd backed these subprime securities, which, as you say, led to the current crisis?
Well, this is where you show the gutlessness of the government organisations that are lining up against the financial sector. They basically kowtow to the financial sector. So even they had the perfect opportunity to draw these people into line in 2008 when the crisis broke out, rather than doing that, they bent over backwards and tried to rescue the entire financial system. And the financial system went back to its same old irresponsible behaviour. In many ways, we need a Rupert Murdoch moment in the financial sector. We've had it, but nobody's gunning for the bosses of S&P in the way that English politicians are now gunning for Rupert Murdoch. Without that fundamental political shift, all we've done is re-establish the power of these financial institutions over the political scene, when we've shown how dangerous that is in the very first place. So we're being let down both by the government politicians and by the financial sector itself.
Yeah, it all goes round and round. Steve, thanks very much indeed for that. Steve Keen speaking to us from Sydney there.